This episode of Super Boothers is brought to you by Audible. Get a free audiobook download and a 30-day free trial at www.audibletrial.com/superboothers. Over 180,000 titles to choose from for your iPhone, Android, Kindle, or MP3 player. Welcome to Super Boothers. My name is Ryan.
And I'm Ismail. And we are here today for the long-awaited, much-anticipated episode on accounting. And what better way to do that than to bring a real-life accountant on the show? Today we are joined by Joseph Viola.
Hello,
Joe,
everybody.
welcome to the show.
How are you? And thank you very much for having me. I've been a big fan of Super Boothers. I've been listening quite religiously since you guys first came out, and I'm very pleased to be here. Thank you for asking me to be here.
Joe, you sound like you're from Brooklyn.
That's exactly correct. Yes, I was born in Brooklyn, and now I live on Long Island, New York. So pardon the accent.
Awesome.
Before we jump into this, I'm just curious, what does an accountant get out of Super Boothers?
There's a friend of mine, pointed me into it. I do have a lot of clients that are photo booth oriented and event planning and things like that. I really love the content that you guys have put out. You can quiz me. I've listened to all of them. And I think that from an entrepreneur's standpoint or from a business owner's standpoint, there's so much content that can be extrapolated from it, not just for photo booths, but for any business. Just last week's episode, they were talking about creating a culture and core values, and that's all administrative. That's all business ended, and I think that goes beyond photo booths. That goes on to any type of business. So I really enjoy listening to it to get a lot of the entrepreneurial and the business administrative ideas out of it, and then applying them to all sorts of businesses. Because as an accountant, I have, industries that range from photo booths to contractors to storefronts to lawyers, so I have multiple different businesses that, I work with, and taking these things that I learned from Super Boothers can be applied to all of them.
Well, I know that people are really anxious to get this content that we're going to be able to give them today, because I think we got the most questions submitted for this show than, not even close to any other show. People are sending in topics, people are sending in questions. So there's definitely a lot of things to cover. And just so people understand the stature of Joe, he handles the accounting for a multi-billion-dollar real estate firm in New York. He's also not just an accountant, he understands the photo booth business because he handles all of my accounting. So through working with me and some other people in the area, he knows the photo booth business, and I think his knowledge and his perspective will be very helpful to the audience today.
Thank you very much.
Well, I don't know about y'all guys, but I am super depressed because this is the most adultiest show that we're ever going to do, and it's very funny to me that we are so excited to talk about accounting.
It's all about money, man.
It is. Everybody needs an accountant. We know. I know a lot of times accountants, talk to their clients, and it's like information overload, and you walk out of their office with your head spinning. We understand it. It's unfortunate.
No, I go out of my accountant's office crying in tears just because I feel like I've just been ripped a new one.
That's the great country we live in, and it is a great country, but it costs to do business here.
Gotcha. Well, let's go ahead and get started. So everyone submitted a lot of questions, and it was very great to hear from everyone. One of the biggest things was sales tax. Now, the big disclaimer here is sales tax is very, very, very much limited to where you are, and that can vary by state, it can vary by county, it can vary by city. But one of the things that we wanted to talk about is, in general, what is taxable?
So basically, like you said, there's 50 states, there's 2,500 localities throughout the country, and it really is specific to the city and state that you are in, and not even necessarily where you're based in. It's actually taxable where the event is being held in your type of business. So wherever that end product is being delivered to, either at an event, or if it's digital or tangible, no matter what goes into it, either labor, the attendant being there, the equipment rental, all the ink, all the paper, everything that's involved in the production of that end product is taxable. I know all photo booth owners right now are cringing and saying, oh my God, I hate that because that just threw off the bottom line. Unfortunately, that is the harsh truth, is that everything is taxable.
I had a conversation with another boother who lives in Texas, which is where my companies are based out of. And the big thing here is in Texas, a photographer is considered a manufacturer. Anything that is used to make the end product, whether it's physical or digital, all of those photos and everything that it takes to make those is taxable. So I think in Texas, there's been such thing as a taxable service with photography since about 2009, maybe a little bit before then. But the big thing here is I have seen horrible things happen with sales tax where people aren't charging it on stuff that they should be charging on. And whenever you get audited with that, you'll have major tax liens that'll come out of it. So the big thing that I've learned is I would much rather overpay on a sales tax than have them come back at me and say, you weren't charging enough, so we need to slam you with this.
Exactly. I mean, the sales tax implications, and again, I'm in New York, which it's fair to say it's one of the most conservative and higher taxed areas. The sales tax penalty could be close to 50% of the tax. So if you're misstating your taxable income or your sales tax items, and they come in and they audit you, once they find that, they're going to slap you with fines, penalties, interest, and everything else. It's going to deplete your bank account down to zero and probably down to negative. And worse off, not only have they audited you and they caught you, now they're going to come back every quarter or every year, and they're going to continue to make sure that you're doing it right. And because you've been audited from the sales tax perspective, now again, that's locality specific. So I'll use, New York as an example. New York came in, audited you for sales tax. Now federal government gets to say, hey, this guy was audited. Let's take a look and make sure he's doing 1099s correct, or he's doing payroll correct, or he's doing deductions correct. And then they'll come in and they'll audit you and they'll see. So you really don't want to open up Pandora's box and like you said, you want to do it conservatively. You want to do it correctly from the get-go because you're just lining yourself up for disaster. So you want to make sure that whatever your taxable rate is in your area, 5%, 10%, whatever it is, get that into your initial planning when you open up your business or when you're revamping your business plan, and make sure that you're accounting for your gross sales minus out 10% or whatever your rate is, to make sure that you're accounting for that before you get to your bottom line and say, wait, there's no money left over in profit because it all went to sales tax. You need to account for that from the get-go.
So I think it's clear that this is not something you want to mess with. Like Ryan mentioned, I actually also knew people early in my career that terrible things happened to because they played around with the taxes a bit too much. And I made the decision early on that it's just not worth it. And I would do everything by the book because I don't want to be put in a situation like that. And it sounds like, just to clarify, Joe, I know you can't speak to every locality in the country, but I've spoken to photo boothers who are under the impression, or their accountant told them, that they only have to put the tax on, the paper and the ink. Are you saying that there's no chance of that, or maybe there are some localities where that's true?
Yeah, absolutely. There could definitely be some localities where that is true. And again, I can only speak to the areas that I've done research on. If there's a photo boother out there that has a question and can't get a straight answer, I'd be glad to, take a look at it. You can email me, contact me through here, however, and I could research it for you. Basically what we would do in a case like that, rural Ohio, let's say, and they say, oh, I'm in XYZ county in Ohio. Is it taxable? We'll go to the Ohio literature and we'll read through it and we'll interpret what their literature states. There will be some people out there that will give you opinions, and that's what accountants do. Accountants read literature, read the IRS tax code, and then give you their opinion on it and say, well, this sentence could be read this way or it could be read that way. Me personally, I go with the conservative approach. This is what it said. There are other people out there that may say, you know what, I've done this for years and this is what the literature says and we're fine with it. And by all means, I mean, basically, when you hire your accountant, I think the one quality that you need to look at in that accountant is trust. You have to trust that they're giving you good advice. Just like you walk into a doctor's office and your medical health is in their hands, you're relying on their opinion and their interpretation of your health. This is the same kind of thing. This is your business's health that you want to make sure it's becoming prosperous. So you want to make sure that you have an honest and open relationship with your accountant.
So not sex appeal. So I should fire my good-looking accountant.
That's up to you. I mean, it's a trade-off. It's a trade-off. I mean, if they're good looking and that's what gets you there quarterly to make the tax payments, maybe that's what gets you there. You know, that's
Perfect works for me.
Yeah, there you go.
So Joe, I think I just want to clarify what you're saying, where the sales tax is applicable to where the event happens. So if you're operating in a business where you're operating in multiple localities with different tax rates, it's up to you as a business owner to track all that and use the appropriate tax rate in the appropriate area.
Yes, unfortunately, yes. You need to track where the event is located. And like you said, especially for us up here in New York, you operate in the tri-state area. You could be in New Jersey in a half hour. You could be in Connecticut in 45 minutes. You could be in Delaware in an hour and a half. Those are all conceivably areas where you could go out to rent. That's 4 different states. That could be 15 different localities. And unfortunately, you need to track those because when you go to an event in New Jersey, even though you're a New York-based company, New Jersey wants their sales tax from that. So you'll have to pay based on where the event was located, where the end product was delivered to.
So let's kind of shift gears here and go from sales tax to more of a federal tax. Mm-hmm. So with federal end of the year, let's talk like charity donations. Like let's say I donate something. What percentage of that is deductible?
So basically it would depend on your business structure. So there's a couple of different ones that you could choose from when you first formed. It could be S corporation, C corporation, sole proprietorship, partnership, LLC. So all of those come with their own type of rules, but generally speaking, any non-political donation to a real recognized charity, you know, the ones that say like 501c3 approved or eligible, something like that, those are deductible, and they would likely flow onto your personal return as charity, just like you normally would. Now,
so what about like is in like an in-kind gift, or like we donated like a photo booth for 4 hours? Like what percentage of that, or like do we attach a number to that or what?
So if you did that, you know, like if you went to a breast cancer walk and you had your photo booth and the attendant there, and you went to the administrator of that event and you said, look, this would normally cost $1,000. Can you please provide me with a letter saying that we provided a non-monetary donation of X dollars? Maybe that's $1,000, whatever that amount is. That would then also go on to the return. Some of the non-monetary is limited, and there's certain, you know, brackets and things like that. So I can't say it's 100% deductible, but you'll get a deduction for it. Again, making sure that these are real eligible charities. Just because it's, you know, the local soccer club and, you know, they're selling Girl Scout cookies, that may not necessarily become charity. That, you know, yeah, it has to be a real recognized charity.
So I think what Ryan was trying to get at is, what if, like, let's say, Joe, I donated a photo booth to your daughter's birthday. Mm-hmm. Is there any deduction that I can get from that kind of gift that's not to a legitimate charity?
Not really. No, that's you just being very nice to me because you like my daughter.
I do like your daughter.
Thank you. I mean, what you could do from a business standpoint, if you were paying your employee to come to my daughter's birthday party, your business would be able to deduct that employee's, you know, payroll because you paid him $100 to come here and stand there. But the fact that you're, you know, forfeiting $1,000 revenue, that's a business decision. That's not you know, being able to get a charity deduction.
So you either do it to a legitimate charity where they would give you a letter for the dollar amount of the rental.
Correct.
Is there ever a instance where I guess a charity may refuse to give you the letter, and then at that point you would just deduct the cost of running the event?
Potentially. I mean, if they refuse to give you the letter, then maybe there's something else going on there. Yeah, I mean, if it's not, if they're not going to give you the letter that says it's X amount of dollars, then it's not going to be able to be deducted.
Gotcha. And I think earlier you were touching on the fact of the importance of trust in an accountant. I think one other question we got a few times was, how do people know if they hired a good accountant? I think a lot of this stuff may be mumbo jumbo to people that are just starting their first business and they don't really understand, and they feel out of their element when interviewing or hiring accountants. Maybe people shop for the cheapest rate. How do you determine, or how can you tell if you have someone that's worthy of being your accountant?
That's a tough question. I mean, that it really goes into a relationship thing. I mean, you'd have to meet with the person, make sure that there's a rapport, make sure that there's an understanding saying, look, this is the type of client I am, and this is the type of accountant that I'm expecting. These are the type of services that I'm expecting. I'm expecting to do things by the book. I don't want to push the needle. You might have some accountants that say, don't worry about it. You can push it 20% and nobody will talk to you about it. Some clients don't like that, or vice versa. So you want to make sure that there's, a meeting of the minds between the client and the accountant. That would be the first thing. How do you, on an ongoing relationship, make sure that they're the right fit or that they're an honest accountant? I think that just comes with, making sure that they're listening to your needs, making sure that they're, replying to you, making sure it's an open-ended conversation, and making sure that they're doing the things not only that you're asking them to do, but that's in your best interest. You might be a client, like you guys have said, you guys are there running business. You don't want to be bothered with federal tax code 191 or this or that. You just want to run your business as profitable as possible. You come to me as the accountant and say, Joe, I want to buy this $50,000 machinery. I heard depreciation's this great thing. I'm going to buy it, right? And the accountant should say, yeah, okay, yeah, sure, no problem. But a better accountant would say, well, look, yeah, you could buy that $50,000 piece of machinery, but it's only depreciable over this many years. It's not really as advantageous. I would suggest leasing it, maybe because you have less cash flow. You want to be able to have that open dialogue to make sure that they're pushing you in the right direction. I mean, it's almost as if it's a consulting relationship. You want to be able to have that accountant a phone call away, an email away, or a visit away to say, look, this is what I'm considering doing in my business, and I want your opinion. Is this going to be a good decision for me? Because admittedly, a lot of photo booth owners or business owners alone will say, look, money is foreign to me. Accounting is foreign to me. I know how to sell products, I know how to book events, and I know how to print the pictures. But anything else in that back office, I don't get. And that's why you need to rely on good people, good bookkeepers, good administrative staff, good accountants, and make sure that they always have your best interest.
So let's go into a couple of scenarios here. So one of the common questions that we get is a vehicle. If you're buying or leasing a vehicle for the business, which is better to do?
Again, that's a tough question. But if you're going to buy a vehicle for the sole purpose of the business, of XYZ business, it would have to be registered in the business name. It would have to be insured through the business, and it would have to be used 100% of the time for the business. And then you can either lease or purchase it, and it's fully deductible along with the insurance expense and the fuel costs, etc. But that vehicle cannot also be your weekend Rolls Royce to go to, the beach with or whatever. That has to be the business vehicle. So the tough part with small business owners is there's constantly this
gray area.
Exactly, of commingling of funds is what we call it in the industry, is when you have your personal, self and your business owner self, there's always going to be overlap. So, yeah, well, I just dropped my daughter off at school, but then I was going to deliver it to the city, so I'm going to count this entire trip as a business expense. Well, technically that's not right. So you can't be dropping your daughter off at school and bringing the material there. It's technically a shared vehicle then. So the deductions would then be limited. If it's, let's say, 75% of the time it's used for business, then yes, 75% of it could be deducted. That's, again, it's a gray area. The other thing with autos that are, automobiles that are, tough to go around. If you have a personal vehicle, and because, again, you're a small business owner and you don't want to outlay that money from the business perspective, that's a great business decision. You already have a vehicle. Drive back and forth with your pickup truck or whatever you have and deliver the photo booths and whatever, and you can track your mileage. And the IRS puts out every year. This year, we're going to say every mile you drive, you get 57 cents per mile as a deduction. Or you can deduct the direct costs associated with that travel. So depending on your area, depending on how many miles you drive, do the math. 57 cents a mile and I drove 1,000 miles is X, but gas in my area is $7 a gallon and insurance is $4,000 a year. Well, maybe if you did the math and said, okay, even if it's 50% of the time I use it for business, those direct costs may get you a better deduction. And those are the types of things that you want your accountant to do for you, that you want your good, honest, trustworthy accountant to do those back of the envelope calculations and say, hey, Mr. Photo Booth owner, it's probably better if you don't lease it, use your personal vehicle, and you get to deduct some of it from the business standpoint. So you didn't outlay any extra money, and you're getting a business deduction for it. It's a win-win there. So you really want that consult.
So speaking of commingling and such, what are the main differences between S Corp and C Corp?
Okay, so C Corp is a regular corporation that is what we'll call a double taxation entity. The reason for that is a corporation is taxed. So you have $100,000 of revenue, $50,000 worth of expenses, you had $50,000 profit, you had a great year. Okay. The corporation, XYZ Corporation, is taxed at a corporate tax rate, which is, let's say, 15-20%. Okay. So that's $10,000 that you've paid in taxes. So now you have a bank account with $40,000 in it, right? But now you're also the sole owner of this corporation, right? Could be husband and wife, could be brothers, could be two, friends or whatever, but there's one or two owners of this corporation. So you say, hey, there's 40 grand in there. Let's take it out. That's our incentive for owning this business. So you take out $40,000. Now you go to file your personal tax return and you get taxed at your income level for the $40,000 that you took out. So not only did you get taxed on that $50,000 worth of money on the business standpoint, but then when you bring it into your personal pocket, you get taxed again. So we call that a double taxation entity, which more than likely is not the right way to go for a lot of small business owners. S Corporation, and again, that's locality specific. There's certain areas like New York City does not recognize S corporations. So if you're located in New York City, they say, okay, we don't care. We're still going to charge you a New York City sales tax rate, which is about 8%. Again, I speak to New York because that's what I'm most familiar with. But okay, so an S corporation, you make that same $50,000 of revenue, and regardless if you take it out, again, now you have this $50,000, you take it for yourself or for your two partners. When that income comes to your personal level, it hasn't been taxed yet. And now it gets taxed at your personal income tax rate, which, again, for most small business owners is likely less than the federal C corporation tax rate. Because a lot of individuals, if this is your only business venture, especially if you're a startup, your tax rate is probably 10, 11, maybe 12%. You're not at the 15 or 20% corporation tax level, and then again 10 or 12%. So the S corporation is likely the way to go. And again, maybe I can't really say that exactly for everyone. That can't be a blanketed statement. But if you're looking at the difference between C corporation and S corporation is likely the better alternative.
Well, and the point that I'm getting here is, whenever I had a conversation with my CPA, she would always make me have two checkbooks, the personal checkbook and the business checkbook. And she goes, whenever you get audited, they're going to go through everything individually. And she goes, if you are making a questionable purchase, she goes, call me and I will tell you if you should use the personal or for the business. Because whenever you're set up as a C Corp or S Corp or LLC, the government really puts regulations on it to where you really do have to respect the business and the purchases that it makes. So you made a comment, for example, you're in a company vehicle, you're out making a delivery. Crap, I got to go pick up my daughter. You go over there. Well, now you're sharing the vehicle. Now it's not solely 100% for the business.
Right, exactly. The commingling of funds is something that any startup that comes into my office, I tell them right away, make sure you open up a bank account. Oh, it's no big deal. I'm just doing some, side business, side photography. Get a separate bank account. It doesn't cost you anything. Go to the bank, get a separate account, set it up. And if you have a decent sized business, set up multiple accounts like an operating account, a tax account, savings account, things like that. And the biggest reason we'll take it for personal versus business first. Like you said, if the IRS or an audit or an entity client wants to come in and audit you, they'll look at the business records. And as soon as they see, Las Vegas, Nevada, they're like, hey, wait, what did this guy go to a hotel for? Okay, maybe
Photo
it's
Booth
legitimate.
Expo.
Yeah. What was that?
The Photo Booth Expo, man. It's business expense.
Well, exactly. But, right, so your Photo Booth Expo could be an expense, but what if you have the, Borgata $7,000 because you took all your friends out? Now, technically, that could be an entertainment expense, maybe. But the idea is we're trying to make sure that if you don't think it's a business expense, don't run it through your business account, because what's going to happen is eventually one day when someone looks through those transactions, all they need is to see one transaction that doesn't look right to, again, open up Pandora's box, and now they're looking at everything.
I went to Olive Garden. I swear it was a business expense.
Exactly. And again, and that's something else. You can swipe the credit card. You can go to PC Richards and buy a TV and say it's for that. As long as you can prove that this is what I used it for. This is what happened at that event. This is why I went to that baseball game. This is why I went there. It was client relation. That's fine. Just make sure that you can back it. I remember going once through a lawyer's general ledger. I'm always going transaction by transaction. I was like my first or second year. I was working for a partner, and the partner that I worked for, he was very liberal. Actually, he was like, yeah, let it go. And I got to like $17,000 line item, and I'm like, what could this be? So I click on it, I open it up, and I see it's like Punta Cana Dreams Resort and Spa, and I was
Love
like,
it.
what is this
Love
guy?
it.
So I go to my partner, and he's like, all right, we got to ask this. So
Nah, it was a massage. It was a massage to release some stress.
Yeah, exactly. So I sent the email to him, and you hit it right on the head, Ismail. I emailed him. I said, hey, we're just questioning this line item. What is it? He goes, oh, my daughter graduated college, and we just needed to run away. He's like, so me and my wife ran away. I said, but what does that have to do with your business? He's like, it was just a celebration. I said, okay. Well, that's not happening. So obviously, we took that off of his records, and we weren't going to deduct it, obviously. But there's certain things about segregating your accounts that it just makes sense. In some aspects, especially with an S corporation, you almost have to treat yourself as two different people. You can be Joe Viola, the business owner, and Joe Viola, the employee of that business. And I've seen people make themselves aliases or nicknames in their accounting systems to say Joe Viola, business owner, and then they'll be like Joey D or something like that. That way they distinguish themselves between, he was worked 30 hours at $20 an hour. He gets paid this because he's an employee. But Joseph D. Viola, he gets to take money out as a business owner. So you really want to set it up two different ways and really distinguish the separate functions that you have as a business owner.
So what's Ryan's nickname? Ryan, what's your nickname?
I don't know. What is it?
Dr. Pepper. So this is the thing here is again, we can be giving out, accounting advice all day long, but the big thing here is everyone really has different instances and circumstances that work for them. I know that my uncle, he owns, a couple pieces of property, and he has the business pay him rent, and then that's the money that he makes personally.
Right.
There's always loopholes and, ways around things. So always hire a CPA or an accountant that can help guide you through these things.
Absolutely.
So one of the next questions that we have is accounting and bookkeeping. What bookkeeping software do you recommend?
I really like QuickBooks. There might be some mixed reviews out there. I find that for small business owners and even medium business owners, it's very user friendly. It's got a lot of different plugins. Now you can run payroll directly through it. You could accept credit cards. It has customer tracking, receivable tracking. It can send out mass emails, to people who may owe you money. So there are a lot of other things in QuickBooks that you like just more than this is income, this is expenses. It also has some standard reports. And I just think it's very user-friendly, very easy, for a mildly tech-savvy person to navigate. And the cost is pretty reasonable. There are a lot more expensive versions out there. Obviously, there's enterprise versions, there's Peachtree, there's other accounting platforms that I just think they're unnecessary for a lot of the clients. Obviously, as Ismail talked before about the real estate company that I work with, we're not using QuickBooks for the multi-billion dollars. But, for the average photo boother,
you're using Slowbooks. You're using Slowbooks for that.
Yeah, exactly. Everything goes a lot slower when you deal with that. There's a lot more zeros you have to type in. It's a lot more. So QuickBooks I like. There are also a lot of free services that you can get online. I know Wave is one of them online. And they provide the same functions. A lot of them, or pretty much all of them, will link directly to your Chase or Citibank, or pretty much any bank nowadays has an online platform, and it'll download stuff right into the accounting software. It may even categorize it for you if you give it a couple of cues on, Staples is this and this is this. And then that way a lot of the bookkeeping work is done. If you get a decent bookkeeping service, if you have a bank that has online booking, online banking, and you're able to go on there and do some light categorization, your bookkeeping fee can come down drastically. Because even if you do 1,000 transactions a month or a quarter, your bookkeeper may only have to look at 100 of those. Less hours, less money. And then if you have a good set of records to provide to your accountant at the end of the year, it could be as simple as saying, here, I have a bookkeeper, so-and-so. Oh, he's great. I've worked him in the area. Yeah, so you know that you're getting a good profit and loss and a good balance sheet that you can just take that and prepare the tax return with it.
Yeah,
so
that's
again,
the thing. It can also be one click.
Yeah, exactly. And QuickBooks actually does do that. QuickBooks, if you have all of the chart of accounts linked up correctly, you can prepare the tax return directly from your, directly from the QuickBooks software. Again, now as an accountant, you would want to make sure that someone's at least giving it a once overview to make sure that all the questions and things are, marked off correctly. But now you're talking about potentially coming from, let's say, a $500 or $1,000 tax prep fee to now, can you just take a quick look at this and make sure it's running right? An honest accountant would say, yeah, this is a great idea.
The greatest thing about this is accounting seems to be like this gigantic nightmare, stress-inducing, holy crap, where's my Xanax bottle kind of thing. And really it doesn't have to be like that. If you're just pretty vigilant about just closing up your books once a month and making sure all the stuff is, in your QuickBooks or in your Peachtree or whatever, at the end of the year, it's really not so scary because everything's already taken care of. One of the things, I drive a lot. I drive like nobody's business. I think I've had my car like 3 years and there's 150,000 miles on it. Jeez. Like, this is no joke. Texas is a big state, y'all. But I have to talk about this just because it's changed my life. Last year, I started using the app MileIQ. You don't even have to turn it on. It just keeps on in the background and it tracks all of your drives. Swipe left for personal, swipe right for business. And if you want to hold down on the button, you can say it was a site visit. I was visiting a client. I was, running an errand, picking up something. It is beyond genius. So I just have to talk about that.
Yeah, that's great. And I'm sure there are a lot of other tools like that are free tools that will make the seemingly administrative nightmare that every small business owner goes through a lot easier. If you had to sit there with a ledger every time you arrived somewhere and said, 38 miles, you'd go crazy. So I'm sure there are a lot of other free tools like that would be very useful.
Well, it's $9.99 a month, but as much as I drive, it's incredibly worth it. But yeah, there are some things that are free. I think they do like 20 drives a month that are free.
Exactly.
So moving on, another huge topic is payroll.
Yes.
And I think at the top of this list is someone an employee or is someone a 1099?
Uh-oh.
Yes, exactly. So
this is a big controversial topic. Just warning you, Joe.
First of all, this is not a controversial topic. There is a right answer and there is a wrong answer.
I hope I give the right answer then. So A lot of times, so 1099 versus W-2. The way that we've interpreted it is that a 1099 contractor, an independent contractor, would be someone that is on again, off again. It doesn't have a set schedule. They come in if we need them, if we don't need them, and we can pay them, at whatever the going rate is, and we wouldn't be required to list them as a part-time or full-time employee of the business. If you have a person who works for you, even if it's just one day a week, consistently, every Wednesday for 3 hours or whatever it might be, once they become a consistent employee, or a consistent person that's working for you, they become an employee. They become a W-2 employee that requires you to pay payroll taxes on that employee. A lot of times with photo booths, and that's the industry that we're going to speak to, the attendants that you have, if they're working every Friday night, even if it's at, New York and then Suffolk County or this one or that one, no matter what they're doing, if it's consistently that they're working with you, they become an employee. And then you have to treat them as an employee. So once you open up into the W-2 employees, now you get another accounting nightmare that you have to go through. Payroll. What's the proper withholding rates? Are they single? Are they married? How many dependents do they have? If I paid them $20 an hour, what is their net payroll? What do I have to write that check out for at the end of the month? Again, there are a lot of places out there, Paychex, ADP, there's local places that will do the payroll processing for you, obviously for a fee. But if you have several employees, if you have 5, 10, 20 employees, it's well worth it. And again, it reduces the amount that your either bookkeeper or accountant has to then revisit for an entire quarter or an entire year's worth when he goes to do the tax return at the end of the year.
I think payroll is one of the things that I am absolutely most passionate about, just because I like that there's just something very cathartic about, I guess, how I have like my little workflow. I have all of my attendants use a little app called WhenIWork, and we'll have the link in the show notes for this. WhenIWork is a little app where they can clock in and clock out on their cell phone. It's geolocated, so you can say, you know what, the office is here. They only can check in within or clock in within 500 feet of this location. My attendants are mobile, so I don't have that feature on there, but they clock in whenever they're headed to the event, clock in whenever they're done with the event and dropped everything off. That is tied into my payroll system. The payroll system that I use is called Gusto. What I like about it is it's very, very, very inexpensive, low monthly, and all they do is I press one button that goes from WhenIWork into Gusto, and all of the hours are populated per employee. Press another button. It says, hey, listen, is this money in your bank account? I say, yes, it is. Press the button, and then it's done. And what they do, and what a lot of other companies do, like ADP and Paychex, is they pay the employee through direct deposit, and then they also pay the state to where, or federal to where the taxes due, and they do all those filings for you. So I love that process because I don't have to do anything.
Exactly. There are quarterly filings that come along with that. Like you said, federal quarterly, state quarterly, maybe even a locality quarterly, depending on what state you're in. So yes, any type of service like that is well worth whatever the fee is. And the WhenIWork app, I've had one of my customers was a contractor. He heard about it, he used that, and he loves it just as much. With the geotagging, he would set it up and say, this job site is located at XYZ address, and he would be able to make sure that the people, arrived on time and were actually where they said they were. So that is a great app.
I watched them like a hawk.
Oh, yeah. Absolutely. And, when he set it up for his employees, and I was actually with them at the time, is one of the guys, it says, when I downloaded it on my iPhone, it said, should I allow, access to my location devices? I said, yeah, hit allow. They didn't know what it was, but that's what enabled them to, like you
I
said,
love it.
Ryan, watch them like a hawk.
I love it.
Now, Joe, is the contractor employee designation really just dependent on this consistent schedule? Like, I think I've heard some people talk about how, if they use their own equipment, then they're a contractor regardless of schedule. And I think that maybe that applies to different business models, because I know people that work in barbershops where they find loopholes to get around it, where instead of paying them a salary, they rent them the chair in the barbershop. So they just pay a monthly fee to the barbershop owner, and that way they're considered contractors. So are those like legitimate ways, or is it dependent on industry, or is it really just about consistent scheduling?
No, it's not just about consistent scheduling. That's one of the qualifications. You're absolutely right about equipment. Same thing with contractors. If they have their own tools and it's not a set schedule, kind of like day laborers, again, they go 1099. What you're talking about with barbershops and salons and things like that, that is, another thing where we have a barbershop and we will rent you the chair for $100 a month or whatever that fee is. And now you're just happen to be in our storefront. So some of what you're saying is industry specific, like the barber example, but for photo boothers and any other business, set schedule is not the only qualifier. It is one of the larger qualifiers. Equipment is the other one. And then there's also insurance. If you have a photo booth attendant who uses your equipment, doesn't have a set schedule, but has his own liability insurance, which we would never have this as an example, but if he's insured on his own, then he may not qualify as an employee under your business. So there are several different tests that you would have to run to determine 1099 versus W-2. I like to use the set schedule and the equipment as the two biggest qualifiers, but there are several others to determine if it's 1099 or W-2.
One of the big things that my CPA says is if you tell the person what time they have to be there and what time they're done, that's an employee. Right. Versus a graphic designer that says, hey, listen, I need you to do this, get it to me whenever. That's a 1099.
Correct. So, and I think that a lot of the 1099 versus W-2, I think if you take a step back as a business owner and you look at what you're asking this person to do, a lot of it can come down to common sense. Like you just said, if you're giving someone a project and saying, please deliver to me a photo strip by the end of next week, it doesn't matter when they work on it. It doesn't matter if they're using their own equipment. You've just asked them to do something. They're an outside vendor. They get a 1099. But if you're telling them, arrive by 2 p.m., you get a 45-minute lunch break, and you get $20 an hour, that sounds like it's an employee. So I think a lot of it, if you take a step back and just look at what you're asking the person to do, week to week or month to month or year to year, you can determine if they're 1099 or W-2.
There's lots of vendors selling photo booths, backdrops, props, and all sorts of other stuff you didn't even think you needed. So what's one place where you can see and compare everything all at once?
The internet.
No. Try again.
The Google.
No, the Photo Booth Expo.
Come see us live and in person at the Westgate Hotel and Casino in Las Vegas, March 12th through the 14th. We have some fantastic giveaways and we can't wait to see you.
And now back to the show. So one other thing I'm curious to hear about is cash transactions. I work in New York. A lot of my customers are on Staten Island and Brooklyn. A lot of shady characters come up and ask me if they pay with cash, can I remove the sales tax and give them a better rate? So I'm curious to hear how you're supposed to handle cash transactions from you.
So cash transactions, I will give you the correct answer is you must record them. Again, if you read through the IRS literature, there is a line that I remember reading about in school, and I think we laughed about it in class, and we still laugh about it till today. There is a line on the IRS tax code that says, any type of miscellaneous income includes things like child support, alimony, etc., blah, blah, and includes all legal and illegal activities that you're involved in. So that means that the drug dealer who's got $1,000 a week, he's supposed to record that, even though it's an illegal activity. I've never seen anyone do it, obviously.
God bless America.
But any cash that passes through your hands is supposed to be recorded or is to be recorded. So for respectable photo booth owners and business owners, you should be recording the cash transactions. But absolutely, I've been in stores. I think my wife may have even said it one time. I think we were going to buy a TV or furniture or something like that. I think it was our furniture when we first got married. And we went in there and the person said, oh, it's going to be $3,000. You know, are you going to finance it? We have 0% financing. And my wife said, how much if we pay cash? And the woman looked at it like we had three heads. And I said to my wife, what are you asking if we had cash? Well, don't you save sales tax? I said, aren't you married to an accountant? Don't you know that that's illegal? I was like, we'll finance it. Don't worry. And we financed it. And she never asked that question again. But all cash must be recorded.
The other, this might be a little accounting heavy, but I think a lot of people don't understand the benefits of depreciation. So I don't know if you want to touch on that just a little bit. I know there's different types of depreciation, but people may not understand the benefits to lowering their income and their expense, the tax they have to pay on their income. So I think if you touch on that, that'd be helpful.
Right. So I'll give a real quick down and dirty example. Depreciation has a lot of different facets to it. It depends on what you're purchasing, how long the useful life is, how long you think that computer or photo booth or equipment is going to last. It's obviously heavily used in real estate, and that's really where depreciation became about, was within real estate when you buy $1 million asset, a home or a building. But basically what depreciation allows a business to do is think about your first year. Think about to when you guys first started. You came out and you said, okay, I have $20,000 and I'm going to invest in a photo booth. And you went out and you spent $20,000 on photo booths. And then you said, okay, I'm going to go buy a storefront, and you got $20,000 credit line and you spent that. And then you said, oh, I'm going to get $20,000. I'm going to buy a car. So you invested all this money right out of the get-go because you were starting up, right? So before depreciation or without depreciation, you would have a $60,000 loss, which you can't use because the IRS doesn't say, hey, if you made 60 grand, we'll charge you tax. But if you lost 60 grand, we'll give you money back. That's not how it works. So if you have such a big loss because you front loaded all of your expenses, the IRS isn't going to say, oh, we'll give you money back. But then they came out with depreciation, and this is 100 years ago. But depreciation, what it allows you to do is it says that's $60,000 of losses that you can't really do anything with right now. We'll let you take that over the next couple of years. And again, there's things like furniture is 7 years, equipment is 5 years, auto is this, building is 27 or 40. So there's different things. But basically, that's $60,000. You may be able to take it over the course of 6 or 10 years. So now, a $6,000 loss each year from year 1 to year 10 to help reduce your future income that you're going to make is advantageous to you, because not only does what you're buying today help you over the next 10 years, the other thing is over the next 10 years, tax rates will likely increase. So that dollar that you spent today may save you 10% of a dollar next year, but then 11% of a dollar, and then 12% of a dollar, and it will eventually go up. And in year 10, you may be saving 15% on that dollar that you spent 10 years ago. So depreciation just basically allows you to take your expenses and cast them over a number of years going forward, and it is advantageous to you. You'll find it a lot with equipment, things like photo booths, obviously, and any other kind of manufacturing equipment, even computers, TVs, anything you guys use, which is very expensive technology. Even there's depreciation rules on software development, which is huge in your businesses. You could spend $50,000, $100,000 in 1 year. All you did was you created something that you loved. Okay, this program is going to do X, and it's going to be it's going to be earth-shattering. Great. But you don't have any customers yet, and you spent $100,000. And now you're going to lose this loss because you had no revenue to go against it. So the IRS is, okay, its software development will allow you to go over X number of years. And now it allows you to get that revenue and then counteract it with that depreciation expense to lower your income or to lower your tax.
I hope people didn't glaze over that because it's a bit more accounting heavy, but I think there's a lot of value that a business owner can get from depreciation. So I thought it was important to touch on that. The final question that I would have is, I think from talking to people, talking to boothers out there, I get the sense that a lot of people may be in business for a year or 2 years already and just now realizing that they're doing things wrong.
Mm-hmm.
Let's say they weren't charging sales tax, they weren't reporting to the government. What would you advise people that were doing things incorrectly, for the first year or two, and now just realized it? How do they go about correcting that or getting themselves on the right footing for going forward?
I wouldn't. I would always say that you want to do the things the right way. So if you've found that you've made a mistake, and again, things that you've heard today, you may find just lend itself to more questions. Ask those questions to either your accountant or to us or to anyone, and get a real answer. And maybe you were doing it incorrectly, or maybe this is just a more conservative approach. If you want to change the way you're doing things, it's suggested. You should be going along the correct lines, of the correct rules that you should be following. There have been people in my past experiences that would say that be consistent. If you always deducted $1,000 in legal expense, if you don't do it this year, the IRS is going to say, oh, maybe all those years he was lying. Okay, maybe. But again, I think that you have to go, and if you're shopping around for an accountant that you're looking to be honest and have integrity, you should be doing the same thing if that's your business model. And I think all business owners want to aspire to be honest business owners for the most part, I would assume. If you found you made mistakes and you want to correct them, I would say correct them. If it's something major, obviously seek consultation, potentially from an accountant or maybe even a tax lawyer. If you've found that you haven't been paying any sales tax because somehow you've been living under a rock and you didn't know what sales tax was, and now you do this calculation and it's $50,000, $100,000, $200,000 that you're going to owe, maybe you should consult with an attorney or a tax lawyer before you make that leap. Say that again?
And a priest.
And a priest, absolutely.
Because you will need prayer after that.
Yes, you will need prayer. And that's the unfortunate part. And that goes with anything in life, I think. And to circle back to something that you said in the beginning, that's why I like listening to this podcast. And again, it's not photo booth specific. I mean, obviously that's the industry that we're playing to, but I think that there's so much more business around it. If you've found you've made a mistake and you want to be an honest business person and you change the way you're doing things to become an honest business person, I think that's not just photo booths. That should be all across the board, I think.
Yeah, I think I definitely agree with that. And so far, this conversation has tons of valuable content. I know we can keep going on and on, but I think we touched on most of the questions that people ask most frequently. Joe, I think you prepared some type of resource that people can check out. Yes. Is that true? Yeah.
Yes. So basically, what I put together is like a one-page PDF of just some of the topics that we spoke about today: 1099s, charity, sales tax, what you can deduct, what you can't deduct, even some of the accounting platforms like QuickBooks and Wave. And basically, I just put it into a one-page PDF as a resource to put out there. It'll be on my website, photoboothaccountant.com. You guys can go visit it if you'd like and download it, keep it. And hopefully it will just answer some of those quick questions that maybe you've always wanted to ask and never felt like you could ask. But it's out there for anyone to use.
Awesome. And we'll have it in the blog and then in our show notes as well.
Absolutely.
Awesome.
Joe, thanks so much for joining us today.
No problem. Thank you very much for having me. I really, really enjoyed my time here. I think you guys are doing a great job. I think it's a fantastic resource. And I know I've been telling all my clients to go listen to it. Thank you very much.
Thank you so much, Joe. I think people will get a lot of value out of this, and you probably will have people reaching out to you with some questions.
I hope so. If you do, absolutely. You can come and contact me, Joe at photoboothaccountant.com, and I'd be happy to help in any way I can.
Thank you so much to Joe Viola for joining us today. You can visit his website at photoboothaccountant.com. If you want to find out about anything that we talked about today, like Gusto or MileIQ or QuickBooks, please visit our show notes. Tell us what you think and follow us on Instagram and Twitter at Superboothers. And if you have any questions, please submit them online at superboothers.com. Don't forget to subscribe, and we'll see you next week.